Lectures in Corporate Finance. The cost of capital. What are the sources of capital for the firms? The capitals of the firms can be classified into debt or borrowings, the use of preferred stock, and common stock or common equity. For the use of debt, it can be classified into short-term, which are, for example, notes payables, and long-term borrowing, which could be long-term corporate bond. For this common equity, the firms can use its internal capitals from the business operation. This one is called retained earnings. After the firms make profit, the firms paid some of the profit out as cash dividend. What is left is retained into the firms for future investment. The firms can also issue new common stock to fund the investment in the firm asset. And the last source of capital is a hybrid capital called preferred stock. Preferred stocks may offer a fixed amount of dividend every period, similar to the characteristic of corporate bond. Preferred stockholders will receive dividend prior to the common stockholders. If in any years the firms cannot offer cash dividends on preferred stock, it can also be accumulated into next years, and preferred stockholders will not force the firms into bankruptcy, unlike bond creditors. If the firm missed any interest payment, the bond creditors may force the firms into bankruptcy. In these lectures, the main focus would be on the calculations of the weighted average cost of capitals. So we're gonna calculate the cost of capital for the firms. But because the firm use more than one sources of capitals, we will calculate the weighted average. So the formula for the chapter is WACC equation. In this lecture, W stands for the weight of each source of capitals. R is the rate of returns for the firm investor. For examples are the rate of returns on debt, RP, rate of returns on preferred stock, RS, rate of returns on the firm's common stock. But for the firm perspective, it will be the cost of each source of capitals. RD, cost of debt, RP, cost of preferred stock, RS, cost of common stock. The concept of weighted average applies when the firm uses more than one sources of capital. The first component is the weight of debt multiplied by the cost of debt, and it will be an adjustment on the after-tax basis. The second component represents the source of capital from preferred stock. It's the weight of preferred stock multiplied the cost of preferred stock. And the third component represents a proportion of financing capital from common stock. Putting all three components together, we have the weighted average cost of capitals, or WACC. Let's refresh again. In these lectures, the firm used three sources of capitals, which are debt, preferred stock, and common stock. An example for the calculations of the cost of capitals. Cummins Technology. We assume a marginal tax rate for the firms of 40%. The firm has existing corporate bond which has 15 years to maturity left. This bond is a semi-annual coupon bond, offers a coupon interest payment of 12% a year. The bond is non-callable and selling at a premium price, $1,153.72. If new bonds are to be issued to the investors, it will be a private placement with no flotation cost. The second source of financing that the firm has is preferred stock. This preferred stock has $100 par value. It offers a dividend payment of 10% a year. It will be paid every quarter. The preferred stock is perpetual, has an infinite life. The current price of this preferred stock is $111.10. The third source of financing is the firm's common stock. The current price is $50. The firm pays dividends of $4.19. This is the most recent dividend. We have to assume additional growth rate of the firm business is equal to 5% constant growth rate. A constant growth rate that goes into infinities. We also have an information from the stock market, which can be used in a calculation of rate of returns using the capital assets pricing model or CAPM. We also have a equity risk premiums of 4%. This is an additional 4% on top of the corporate bond yield. The last set of information is on the target capital structures. The firm is planning to use 30% debt, 10% preferred stock, and 60% common stock. The target capital structure for the firm is the most preferred way used in the calculations of WACC. In a calculation of WACC, one important set of information are the weight of each capital component, the weight of debt, the weight of preferred stock, and the weight of common stock. The most preferred weighting scheme are the target capital structures, whereas the firm is planning to use a proportion of each capital component according to the firm's capital structure policy. However, as a financial analyst, we may be not able to obtain the target capital structure policy, which can be a classified information within the firms. So we're going to use the market information. We can use the market value weighted. And the least preferred weighting scheme is when we use information from the firm's balance sheet. So we could use the accounting numbers or the book weights only in the situations that we cannot obtain the market value weight. That's because we don't know the market value of debt, we don't know the market values of preferred stock, and we don't know the market value of the firm's common equity. Then we can use the accounting numbers available in the firm's balance sheet or the firm's statement of financial position. And the book weight are the least preferred approach to be used as an input in the calculations of WACC. Let's look at a numerical example for Coleman Technology. The firm has three sources of financing: debt, preferred stock, and common stock. Please notice that the use of debt includes both short terms and long terms. The case specified as the firm has the target capital structures. The firm's planning to use 30% debt, 60% equity, and 10% preferred stock. This is the most preferred weighting scheme that we can use in the calculations of WACC. However, if we are an external analyst, we may not be able to obtain the target capital structure policy of the firm, so we can use an alternative weighting scheme. We can use the market value weight. To calculate the market value weight, we need to know the market value of debt, market value of equities, and the market value of preferred stock. Sum all sources of these market value together, and then calculate the percentage of the market value of debt, percentage of the market value of equity relative to the total sums of three sources of financing. Then we can use these numbers as the market value weight. The last alternative is to use the book value. So we can look into the firm's balance sheet, look at the book value of debt, book value of common equity, and book value of preferred stock. Sum of them up to get the total book value of the firm's capital. Then we can calculate what are the proportions of debt, what are the proportions of equity, and what are the proportions of preferred stock. They can be calculated as percentage of total capitals. Again, the most preferred weighting scheme is to use the target capital structure scheme. However, in practice, we may be able to obtain the market value of the firm's common stock, but we may not be able to obtain the market value of the firm's debt if the firms borrow from financial institutions. Let's say firm have short-term financing and long-term financing by borrowing from a financial institution. So we cannot calculate the market value of the firm's debt. Then we can use the book value of the firm's debt as an alternative. Then we can assume that the book value of debt is properly equivalent to the market value of debt. If the firms owe a bank $100, is the market value of debt that the firm has to pay the bank $100. In this kind of scenario, then we can mix by using the book value of debt and the market value of equities into a calculations of WACC. Let's start the calculations on the cost of debt as the first source of financing capital for the firms. In these calculations, we're gonna calculate RD, and it will be adjusted on the after-tax basis. So RD is the rate of returns on debt. For the firm, is the cost of debt. We're looking at the marginal cost of debt, which means if the firms want to borrow today, how much it's gonna cost. The marginal cost of debt is not a historical cost of debt, so we do not care about during the past 5 years how much does it cost the firm to borrow. We only look into the futures that if the firms want to borrow today, how much it's gonna cost, and that's the concept of marginal cost of debt. In these examples, we're going to calculate the yield to maturity on the firm's existing bond, which is the rate of returns for the bond investors if they invest in the firms today. This is therefore corresponding to the concept of marginal cost of debt for the firms. The cost of debt will be adjusted for an after-tax basis. The companies will make an interest payment before it pays corporate taxes, so interest payments are tax deductible. The firms has 12% semi-annual coupons bond. This bond have 15 years left. The end in the calculation is 30s or 15 multiplied by 2. The coupons payment is 12% of par $1,000, and the coupons payment is 6% every 6 months. So 12% is divided by 2 and then multiplies by $1,000. The current price of the bond is the premium bond. It's selling at the price above $1,000. So this is the present value into the calculations. We solve these equations for I, which is the interest per period. It is the cost of debt for the firms. The cost of debt for the firm is annualized at 10%. So it is 5% from the calculation, which represents 6-month period, multiplied by 2. It is equal to 10% a year. The interest payments are tax deductible. It helps the firm save taxes. There are tax savings from the use of debt, so we have to calculate the cost of debt on an after-tax basis. If the firms want to borrow today, the marginal cost of debt for the firm is 10%. So this is the rate of returns before tax. It's the rate of returns that the firm must offer to the firm's investor. Let's assume $100 as the principal amount of debt. The firms will pay 10% or $10 to the bond investor. By having an interest payment of $10, the firm will save taxes by $4 because interest payments are tax deductibles. As a result, the actual cost for the firms is $6. Again, the firms make a payment of $10 to the bond investors. This is an actual interest payment. However, the firm will save taxes of $4. So the net amount that the firm will have to pay by this borrowing transaction is only $6. Pay 10, save 4, so the net payment is only 6. The transaction costs for new debt issues are small, so we will ignore the flotation cost for now. This calculation helps us achieve these terms, the after-tax cost of debt. Next, we can calculate the cost of preferred stock, RP. We also apply the same marginal concept, so this is the marginal cost of preferred stock. How much returns do the firm investor requires on the preferred stock? Since the firm preferred stock are not tax deductible, we don't need to adjust for taxes. We're gonna use just the nominal RP. Also, we will ignore the flotation cost for now. For the calculations of cost of preferred stock, we learned from the stock valuation process that if we assume a constant rate growth equal to G under the discounted dividends model with constant growth, P0 is equal to D1 over R minus G. In this example, the preferred stock is perpetual, so G is equal to 0%. Then we can flip the formulas to calculate R. R can be calculated as dividends over price. Because dividend is constant, so whether it's D1, D2 or D3, it's the same as D. It is just the dividends per year divided by the current price of the preferred stock. In this calculation, is equal to 9%. This is the cost of preferred stock for the firms. Let's see the riskiness of the preferred stock versus the firm's corporate debt. Preferred stock is more risky than the firm's debt. As a result, the cost of preferred stocks will be higher than the cost of debt on an after-tax basis. The cost of preferred stock is 9%. The cost of debt on the after-tax basis is 6%. This is consistent with the risk characteristic of each securities. The last source of financing that the firm has is common equity, so we're going to calculate the cost of equity for the firms. RS is the marginal cost of common equity or required rate of returns on common stock. We may use the terms common stock and common equity interchangeably. This is the part of the owners for the firms, so the firms can use internal financing resulting from retained earnings, or the firms can issue new equities. First, take a look at the concepts of retained earnings. After the firms pay earnings out as dividend, the firm will get to retain the earnings for reinvestment into the firm asset. This amount of retained earnings has an opportunity cost. The stockholder of the firms can use this retained earnings to earn the rate of returns on an alternative investment of equal risk. So we have to calculate the opportunity cost of retained earnings. Now in the calculations of WACC is the rate of returns earned on common equity or the rate of returns earned on common stock RS. We have three alternative methods to calculate the cost of common stock or cost of equity. First, using the capital assets pricing model, which is the risk-free rate, plus additional risk premium that calculates from the market risk premiums in the parentheses multiplied by the firm's beta. The second method is to use the discounted cash flow approach. In this approach, we must add additional assumption, which is the constant growth rate equal to G, into a calculation. It is the discounted dividends model with a constant growth equal to G. The third approach is to use the corporate bond yield as the basis, RD as the basis, plus the equity risk premiums equal to RP. And equity risk premium practically come from the estimation using historical data. If you notice, under the capital assets pricing model, the basic rate is the risk-free rate, plus the market risk premiums multiplied by the firm's beta. The third approach uses the basic rate, which is the corporate bond yield, plus the equity risk premium estimated from the historical data. Both approaches have some similarities, but they are not the same. Let's look at CAPM. If we look at the risk-free investment, the rate of return of risk-free investments is equal to 7%. If investors have to invest in the stock market, investors will require an additional return of 6%. So 6% is the market risk premiums. From 7% of risk-free investment, add up 6% if investors have to invest in the overall stock market. So investor will require the rate of returns equal to 13%. The market rate of returns is equal to 13%. The firm systematic risk is equal to 1.2, which is greater than 1. So the firm's stock is more volatile than the overall stock market. Putting this into the equation, the firm's beta multiplied by the market risk premium of 6%, added on into the risk-free rate of 7%. So we get the rate of returns on the firm's common stock, which is equal to 14.2%. This is a calculation under the capital asset pricing model approach. Under the discounted cash flow approach, we use a discounted dividends model with a constant growth equal to 5%. So G is equal to 0.05 in an equation. We flip the formulas to calculate R, which is equal to D1 divided current price plus 5%. So we get the rate of returns on common stock equal to 13.8% under the discounted dividends model with a constant growth rate equal to 5%. The third approach is to use the corporate bond yield, which we initially calculate as 10%, plus the equity risk premiums of 4%. The concept of risk premium is similar to the CAPM approach, but it is not the same. So this is more like a ballpark estimate. Analysts can estimate the equity risk premium using historical data. They can find the historical rate of returns of the equities market in addition to the yield on the corporate bond market. This approach is based on the experience of the financial analysts. In this lecture, is equal 10 plus 4% or 14% under the bond yield plus risk premium approach. If we have more than one estimation approaches, we can use an average number. In this example, we have 3 approaches, then we can find the average of the 3 approaches. In this example, is equal to 14%. This is the cost of equity for the firms in our example. Next, we're going to address on the issues of transaction costs. If the firm has to issue new common stock, it must pay transaction costs to the underwriters. The underwriters are pretty much financial brokerage firms authorized by the central bank that can underwrite the firm's common equity and distribute it to the public investor. Then we have to incorporate the concept of flotation costs into the calculations of WACC. Let's take a look at an example. Let's say the underwriter charged a transaction cost of 15% of the amount of equity that the firm plans to issue to the public investor. The cost of common stock will have to be adjusted. In this example, we use the discounted dividends model. The price of common stock is $50. But because the firms will have to pay a transaction cost to the underwriters, which is equal to 15% of the price, when the firm issue new common stock, the firms will not receive $50. The firm will receive only $42.50. That's because for the issuing price of $50, the firm will have to pay 15% to the underwriters. The net receipt for the firm is only $42.50. When we do the calculations for the cost of equity for the firms, initially we get the cost of capital for the firms equal to 14%. After incorporating the transaction cost, the cost of equity will increase. In this calculation is equal to 15.4%. This is an adjustment if we need to adjust for the flotation cost for the new common stock issues. Flotation costs are pretty much very high for common equity. It will increase the cost of capital for the firms. Fortunately, most firms do not issue new equity frequently. When the firm decides to use debt financing, the firm will be able to save a lot of transaction costs for the new equity issue. So oftentimes we will ignore the flotation cost in the calculations of WACC. Now let's see a punchline in our lecture. To calculate the weighted average cost of capitals, we look at WACC equation. We have the cost of debt, which is 10%, multiplied by the 1 minus marginal tax rate to obtain the after-tax cost of debt. We have the cost of preferred stock equal to 9%, cost of common stock equal to 14%. Based on the firm's target capital structures, the firm plans to use 30% debt, 60% equity, and 10% preferred stock. So these are the weights used in the calculations. We calculate the cost of each component multiplied by the weight. Then sum them up. We get the concept of weighted average cost of capital. This is equal to 11.1%. Factors influencing the cost of capital for the firms. The calculations of WACC depending on the stock market condition. If stock is more volatile, investors gonna require higher rate of returns, and the cost of capital for the firms will be higher. It also depends on the firm capital structures. When the firm use more debt financing relative to equity financing, the cost of capital for the firm will be relatively lower. WACC also depends on the firm investment policy. If firm invest in risky projects, investors will require higher rate of returns to compensate for higher risky projects that the firm have invested. So the cost of capital for the firms will be higher as a result. This part discusses the concept of WACC as a hurdle rate. When we want to apply the concept of the firm's WACC to evaluate each project, can we use WACC as a cut-off point when we estimate whether our investment projects are profitable? Because different projects have different risks. The project cost of capital must be adjusted to reflect the project risk. In this example, the firm's overall WACC is equal to 10%. If we look at a high-risk project, the high-risk projects offer the rate of returns equal to 11%. When we compare 11% rate of returns from the project with the cost of capital equal to 10%, we will accept this project as profitable investment. However, because this project is riskier than the overall firms, the cost of capital for the project must be adjusted upward. This diagram shows that the cost of capital for this risky project must be equal to 13%. So we will not compare the rate of returns of this project with the firm's WACC. Nope. We will compare the rate of returns from this project, 11%, with the cost of capital of 13%. In this situation, we will reject this project because the returns of the projects of 11% is less than the cost of financing, 13%. This diagram shows that the firm cost of capital must be adjusted to accommodate the risk characteristic of each project. Coming to the end of chapter exercises, we have 3 questions. The first exercise warms you up by giving you the exact target capital structure, debt, preferred stock, and common stock. Then it gives you the cost of each capital component, cost of debt, cost of preferred stock, and cost of common equity. You plug these numbers into the WACC equations to obtain the weighted average cost of capital for the firms. The second question requires certain calculations on the firm cost of debt and the firm cost of common stock. In these questions, the firm have 2 sources of financing, debt and equity. The first part provides you information on the firm's corporate bond. You have to calculate yield to maturity of this bond to obtain the cost of debt for the firms. And the cost of debt must be adjusted to be on an after-tax basis. You are given the market information used in the capital assets pricing model to calculate the cost of common stock for the firms. The last set of information contains the target capital structure policy for the firm, which use debt and equity. The firm does not expect to issue any new common stock. We do not have to incorporate flotation costs into the calculations of WACC. Questions number 3. In these questions, the firm will issue new common stock to finance its investment in the firm asset. The firms have 2 sources of financing, debt and equities. The flotation cost for this exercise is equal to 10%. You have to incorporate flotation costs into the calculations on the cost of common equity and then calculate WACC. To accommodate the cost of capital lectures, you are required to do the case analysis of Nike Corporation. In this Nike case, Exhibit 5 shows the calculations of WACC. This number is not correct. Your assignment is to revise the calculations of WACC. You must calculate the cost of debt and cost of equity for the firms. You must revise the numbers of the weight used in the case. The numbers in Exhibit 5 are not correct and should not be used in the calculations of WACC. Remember, the most preferred weighting scheme is to use the target capital structures. If we cannot obtain the target capital structure, which is the inside corporate information, we will use the second preferred approach, which is the market value weighting scheme or the market value weight. In this case, you can use the capital assets pricing model to calculate the cost of common equity for the firms. The market information is available in Exhibit 4. Good luck.